Now we're recording. Thank you very much for reminding me for that. Okay. All right. So the order that these variables are in, okay, I'm not going to change that for the midterm. Right. So what you see in terms of the variables listed and in the order that they're listed in, that's exactly what you're going to see on the midterm. So you can literally take the Tasha mini case and you can build your framework for the midterm. Okay. And so, you know, based upon what we talked about with Tasha, right, that you're going to have to build the income statement. All right. And based upon what we did with S&S Air, you've already kind of got all the variables. So you can go ahead and you can pretty much just build, right, the whole left-hand side. You know you're going to have that. Okay. And so when we deal with the income statement, or we deal with just Excel in general, right, it's all about creating links. It's all about simplifying your life. It's all about making one change and then having that one change flow through your entire analysis. Everything that you're going to do for the midterm is all based upon this data table. That's it. So everything kind of needs to link in so that when you get the new numbers, all you have to really do is plug in the new numbers and your entire spreadsheet automatically populates with all the new data. Okay. So with sales, right? So we just link it. So when we want to link something, it's equals, and we reference the cell that contains the number we're looking for. So sales, we're trying to reference sales. We click that, right? Cost of goods sold, we link that. Okay. I'm going to skip gross margin for a second, because what we're doing now is we're plugging in the variables that we know can possibly change. We know that gross margin is always sales minus COGS. We know that. SG&A, always going to change. So we just reference SG&A. Depreciation, we reference depreciation. So if I give you depreciate, if you set your Excel file up and I change depreciation to $1 million and you make the change here at $1 million, it'll automatically show up here, right? Makes sense. Interest. Okay. Taxes, we'll get to that in a second. Okay. So we know gross margin is equal to sales minus cost of goods. Do not fall into the trap of hard coding these intermediate calculations. Okay. Do not hard code $650,000 as gross margin, because depending upon what numbers I give you for sales and cost of goods, that's obviously going to change what the gross profit, gross margin is, right? So get in the habit of all these intermediate calculations, doing the math within Excel. Okay, don't rely on your calculator. Use Excel to do the math. It's error proof. So gross margin, sales minus COGS. EBITDA is equal to gross margin minus SG&A. Okay, EBIT is equal to EBITDA minus depreciation. Okay, EBT is equal to EBIT minus interest. Okay, we're doing these intermediate calculations within Excel. We're letting Excel do the work so that we know that we're error proof. Okay, we're not doing anything in the calculator and then hard coding. It's all getting done within the tool. And then we know taxes are at 21%. Okay, this variable of EBT. So when we're setting up Excel, we're referencing the tax rate. Okay. When we know that the tax rate's not going to change, whether it's year 1 or year 50, right? We know that the tax rate is going to be consistent. We need a way to fix this cell. So if I want to copy and paste whatever formula that I'm going to put in next, I never want that tax rate to be anything other than that particular cell C4. So I have to use those fancy dollar signs. Okay, so my taxes is equal to my EBT, earnings before taxes, right, times the tax rate that I have. But now I have to fix the tax rate because I want to be able to copy this formula wherever I need to copy it without ever changing the tax rate. So if you're on a Mac, you hold down the function key and you push F4. That will add both of the dollar signs around the cell, which fixes that particular cell. If you're on a PC, just push F4. Okay? Or if you don't want to do the function F4 or F4, just put dollar signs before the column and before the row. That says, all right, Excel, I'm referencing my EBT, right? And I'm always going to take whatever cell above this tax calculation, and I'm going to multiply that by this 21%. Now, what does that allow me to do? Why is it important to fix that cell? Anybody have an answer? What does it allow me to do? You know what it allows me to do? It allows me to, when I want to calculate the taxes for 2021, I just simply have to click, see this little, in the lower right-hand corner, there's like this little square, right? If you hover over it, your cursor will change. See how it changed? If you click and drag, right now, my tax calculation is referencing whatever I calculate for my EBT in 2021 times my tax rate. I've kept that tax rate constant. Okay. So when we move to 2021, we know the gross margin, the formula is the same, right? Sales minus COGS. So I can drag that. We know EBITDA is the same formula, gross margin minus operating expenses. I can drag that. We know EBIT, same thing, EBITDA minus depreciation. EBT, same thing, EBIT minus interest. Those intermediate calculations remain the same, right? So we can click and drag, no problems. And then our net income, right, was obviously EBT minus taxes. So intermediate calculation, we can click and drag that as well. Okay. So now we're kind of set up. We've got all those intermediate calculations already ready for the next year. So when we link in the growth rate, okay, growth rate's also kind of constant, right? If we're going to grow at 10% per year, we can link back to the prior year's sales and the growth rate. So I reference back to the prior year's sales, and I've got a growth rate. So plus, times 1 plus the growth rate, right? Now, when you think about the midterm and you think about kind of what we've been building on for the whole semester, right? We're starting to get into multiple year projections, right? So if we've got some growth rate, maybe we're growing at 10% a year. So we need to kind of make sure that that 10% stays constant. So again, we fix it. Because we're also thinking, well, there's a lot of other things in this income statement that vary with that growth rate. So to save myself some time, right, I'm going to fix the growth rate. So then all I have to do is copy that formula down to the other variables that also vary with sales. So I can take that formula, right? We know cost of goods varies with sales. We know SG&A varies with sales, and we know depreciation is projected to vary with sales. So we just have to copy and paste. Okay, because the way we set it up was we said, hey, Excel, give me the cell prior, give me the cell adjacent, okay, and multiply that by 1 plus the growth rate. So by setting it up that way, you've told Excel, if you copy this formula and you put it here, it says, oh, hey, give me the cell next to it and increase that amount by the growth rate. And then with interest, we know that interest kind of stays the same for now. So it's just simply equals the prior year. Okay. So I want to stop there for a second and ask if anybody's got any questions about how to set Excel up, because what I'm going to do next is going to kind of parlay into the whole discounted cash flow conversation here in about 5 minutes. So does anybody have any questions as to how we went about setting all of these different cells up? We have our variables, right? We have the things that we're going to be given information about, right? Sales, COGS, SG&A, depreciation, interest. Everything else are intermediate calculations based upon whatever inputs I give you, right?
How did you click the different cells at the same time?
Okay. So on a Mac, you just hold down the Command key. So like if I want to copy this, right? So I'm copying, so Command C to copy. And then, and I know that I'm going to select what varies with sales. So I click cost of goods as the first one, for example, right? Because we know that varies. And then when I want to make multiple selections, I want to do something to multiple cells, just hold down that Command key, keep holding it down, and then select the cells that you want the formula to be applied to. And then once you've selected them, paste it. Control Open Apple V, Command V. Okay.
Thank you.
Sure. You could also do it like individually, like, so you could do Control C to copy it, and then you could do Control V. It's still active, and then you can hit Control V if you want to. You could do it that way as well. Just your personal preference. I like to just highlight and do it once. So why is it important to set things up this way? Like we've referenced the data table, right? We've got the first year done. We've made a projection to the next year. Okay. And within the next year, all of the variables that might relate to a forward projection are already baked in. So now if we've done it properly, and I said, give me a 2022 projection using the same assumptions. Well, if you've set it up properly, all you have to do is just highlight all of the data and drag it over. Okay. 2022 takes the prior year revenue and goes up by 10%. Cost of goods takes the prior year cost of goods and goes up by 10%. Okay, gross margin is still sales minus COGS. SG&A, prior year, goes up by 10%. EBITDA, still an intermediate calculation. Depreciation, again, goes up by the growth rate. So as long as you've set it up properly, like I get asked for, right? I could say, take this out to 2028. And all you got to do is do it one time. So 2021, that's what you did. And you just drag it out to 2028. And now you've got a 1, 2, 3, 4, 5, 6, 7, 8-year projection done in a matter of seconds. Once you do that first year, as long as you've used Excel, the power of Excel, okay, then it's very easy to create these projections instantaneously. Questions about how, like, we went about getting out to all of this? Because remember, it's the same thing. Like once you do that first year, we're growing at 10% per year, right? So whatever we did in the year prior, we're growing 10% beyond that. So as long as we're just using Excel to reference, okay, to reference the prior year, and we're incorporating the growth rate, it's very easy to then create these 10-year pro formas in a matter of seconds. It's just setting it up properly. I very much believe, based upon what I've seen on the, the homework assignments and also, on the quiz, that, you guys know how to set up an income statement. Like, you know how to create this table with the data that you're given. But what I'm feeling is that we're struggling a little bit using Excel as the tool to do all of this. So if we have questions, now's a good time. No? Okay, let's go to balance sheet. Well, let's just finish up. Let's just do this part too, because we're going to need it anyway. So dividends, right, equals payout ratio, which is going to remain constant. So we need to put the dollar signs, right, times net income. Okay, addition to retained earnings is equal to net income minus dividends. Now that I've fixed my payout ratio, and I know that my retained earnings is just simply net income minus dividends, I can highlight both of those formulas, click and drag, and I've got the next year. Okay, the formulas move with you. Everybody got that piece? Sorry. Like formatting, like I'm a huge stickler on formatting. It just is like one of those like pet peeves that I have. So even I have to do it myself. Okay. So everybody clear on how I did that? I just set the formula up one time to reference the cell above it, which just happens to be net income, and the payout ratio. So on the midterm, I could, instead of it being 40%, I could give you 25%. And then you would just simply have to put in 25%. Your retention ratio is obviously 1 minus the payout, so that will automatically change. And your dividend calculation will automatically update, because now it's being referenced to 25% instead of 40%. So as long as you're referencing back to this data table and syncing everything up, your midterm is going to be a piece of cake. It's just going to be a matter of typing in the answers to your answer key instead of worrying about building some Excel spreadsheet. Okay. Right, so we're going to keep it at 40 because that's just what we've been using in lecture. All right, everybody clear on that one? So you can just use that same methodology about using Excel to your advantage, and you can apply that to the balance sheet. I mean, does anybody feel like they need me to go through the Excel functionality as it relates to the balance sheet? It's the same kind of stuff where we're just simply linking back to the prior year and then adding the growth rate to it. It's no different. The methodology is the exact same. Is there something on the balance sheet that you guys want me to review?
This doesn't really have to do with like the Excel, but can you just go over again, like which ones would change based on the percent growth
Sure.
in the balance sheet?
Yeah, let's do it. So I'm going to copy what I had before, just so I don't have to reformat everything. Okay, I'm going to dump all this stuff. Okay, so now I've got it clean. So again, use the format that you've already got. All right, don't recreate the wheel every time. Okay, we know these are intermediate calculations, so you can always have these done, right? So if we look at the data that we're given, Okay, I'm going to hide the income statement for just a second so that we can just deal with the balance sheet. Okay, so if we look at the data that we're given, okay, we just have to start referencing. So cash equals cash. Accounts receivable. Oh, what do we say about accounts receivable? That's days sales outstanding, right? So we have our sales. Okay, we have our sales, all right, divided by 365. So we have the dollars per day, right, that we generate, and we multiply that by the days sales outstanding. And we had inventory turnover of 12. So we took our cost of goods sold and we divided that by 12. Okay, so we have our current assets of $200,000. Okay, and we're told what our NFA is, right? So we now know that our estimated 2020 total assets is $825,000, right? So that's the starting point. So to Cassie's question about now, how do we figure out what varies with sales? Now we have to ask ourselves, if we sell more product, what is also going to go up by that same growth rate? Well,
Sorry, super quick. I have a question.
yeah.
How did you get accounts receivable again? Just like the actual function of it.
Oh, sure. All right. So accounts receivable, like don't overthink this stuff, right? If your entire, you know that accounts receivable relates to sales, correct? Revenue, because that's how much we're trying to collect. And we know that we have 7.3 days in receivables. Okay, so if we think about the total dollars that we're doing in a given year, right? And we figure out, well, how many dollars am I doing per day? It's just my annual divided by 365, right? So I'm doing 3424.66 per day. So if I'm doing that per day, and I've got 7.3 days in receivables, then by definition, my dollars per day times the number of days gives me my accounts receivable, right?
Okay, yeah, thank you.
Sure. Or you could do it my long way of deriving that number based upon the ratios that are within the table. I think it's what, 3.5 with all the financial ratios. But just think about it in general terms. Like you're doing $1.25 million per year. So how many dollars per day are you doing? So you divide it by 365. And then how many total days is it taking you to collect your money? So you multiply it by the total number of days, and now you've got total dollars in receivables. Okay. Same thing with inventory. You know that it's costing you $600,000 a year, and you know that you turn over your inventory 12 times a year. So 600,000 divided by 12 gives you the value of the inventory on the balance sheet. Okay. So now we got to figure out, like, what do we vary on the asset side before we even talk about liabilities? Well, everything varies with sales. Everything on the asset side varies with sales. So just like we did on the income statement, equals whatever we did prior, right? Times 1 plus my growth rate. Now, I'm going to have to do this multiple times, right? So we want to save ourselves some time, correct? This is why we use the dollar signs. So we know we're going to have to vary multiple variables on the balance sheet, right? On the asset side and on the liability side. So it's to our advantage to fix the growth rate, because now it gives us the ability to copy and paste this formula wherever we need to any of those variables that vary with sales. And we don't have to retype the formula every single time. Right? So I've fixed the growth rate. So my cash projection is 10% higher than what it was the year before, because it varies with sales. But now that we were fancy and we used some Excel wizardry and we fixed that cell Now I can copy that cell. And Sarah, this gets back to your question. Now I can just highlight the cells that I know vary with sales, right? I know accounts receivable does, I know inventory does, I know NFA does, and I know accounts payable does, right? I know that all four of those vary with sales. So as long as I'm copying the formula and I've set the formula upright, then I can paste my formulas and I'm done. And we haven't gotten to AP yet, but it'll fill in once I get that. Right? So cash went up, AR went up, inventory went up, PP&E, NFA went up, total assets went up. Everything on the asset side went up by the 5%. And we're just using the dollar signs to make our life easier to set things up. Okay? Because now if you got this set up, I don't need to tell you what 130, what the cash is in 2021. I just have to give you what 2020 was so that you can build the actuals. And then I just got to tell you the growth rate. Okay. So accounts payable, just like we did with accounts receivable, we have days payable outstanding. And what item on the income statement relates to accounts payable in terms of ratio analysis? Cost of goods sold, right? The money we owe to our suppliers. Okay, so we reference, so equals accounts cost of goods sold. Okay, now what's my per day cost of goods sold? Because it tells me how many days it's taking me to pay my bills, right? So $600,000 per year divided by 365, that tells me how many days, how many dollars per day I'm essentially expensing for raw materials. And I have 10 days that it takes me to pay my bills. So times the days payable outstanding. Okay, and look what happened. Once I gave Excel the 2020, because I'd already copied the formula 1 plus the growth rate, it automatically told me what my projection was. So when you're setting this up for the midterm, get these formulas just put in there. It's going to be 0 because you're not going to have anything necessarily on the inputs. But once you input all of the raw data, your next year's already done. You don't have to even think twice about it. Okay. Long-term notes payable, right? So notes payable, right from the data that you're given. And we know that notes payable doesn't vary with sales. So all we're going to do is reference back to the prior year. So you can essentially get the formulas already ready to rock, okay, for your projection. Long-term debt is equal to long-term debt. Okay. And we know that long-term debt from a projection doesn't vary with sales. So we just reference back to the year prior. Common stock, we are told what common stock is. We know that common stock, long-term debt, notes payable, right? We might ultimately decide to do something with those, right? Because those are management decisions. Those are finance decisions. So common stock stays the same. All right. Let's test the wizardry. Okay. How do we come up with the 2020 retained earnings? We went through this on Wednesday. What do we have to start with?
The 2019 retained earnings.
Okay. So we have to start with the 2019 retained earnings. Right. So we're using Excel to reference back to whatever number is going to be in that when I give it to you on your midterm. You're not hard coding 193,732 into that cell. you're referencing, you're linking, so that when you update that assumptions table, everything else flows through. Okay, that's the beauty of this software. So in addition to what we start with in 2019, right? We also had something else. So we started 2020 with what we ended 2019 with, but then what do we have to add to that number to get to 2020?
Addition to retained earnings.
Yes, Katie, very good. Okay, so we have to take what we started the year with, right? And add to that what we added to retained earnings as a result of our operations. All right, and when we do that, we now see we're balanced. Okay, so our 2020 actuals, everything balances. Okay, now how do we come up with the 2021 estimate for retained earnings?
From the projection that we got for the addition to retained earnings and then add it to the 2020 one.
Right. So we start the year with what we ended the prior year with, right? So equals the cell before. And we're adding to that our projection for addition to retained earnings. Okay, boom. Okay. So if you set your Excel file up like literally exactly like this, the only thing that you have to do is just put new numbers in the assumptions table. Because if you do that, all right, I could change the growth rate to be 20%. And all you'd have to do was change this to 20. And then look what happens. Your entire income statement just went up by 20% with what varies with sales. Your balance sheet, all of your projections, the ones that vary with sales, just went up by 20% instead of 10%. Right? And if you want to take it one step further, you know you're going to have to calculate EFN, and we know that EFN is the difference between our assets and our liabilities on a projected basis. So we know we can go ahead and just calc that minus that, right? We know that's the EFN. So now we're set up to calculate EFN, right? So now if I go back and I say, oh, just kidding, the growth rate's 10% and the payout ratio is 25%. Well, it's all done. You don't even have to think about anything, because I'm not gonna, I told you already, I'm not gonna, mess around with you, and I'm not gonna change the order that these are in. Okay. So you can set this up. You can set this up, and you can set this up right now. Okay. All right. Questions? I'm going to stop there for a second and see if we've got any questions.
Okay, so sorry, one question.
Yep.
On the accounts payable, I got the original one. Obviously, it's like the 2020 is like cost of goods sold divided by 365 times the days payable outstanding.
Right.
Which what got me the answer. But then when I try and drag it, it won't let me drag for some reason. Do I have to like do
all right,
something with
so
that?
yeah, this one you can't drag, right? Because we're trying to figure out what the projection is for 2021. And we know that accounts payable varies with the growth rate, the sales growth rate. So you're not dragging the accounts payable. You're calculating the growth rate on top of what it already was.
Okay, so then
So this
just
one's
walk me
not a
through doing
click and
that?
drag. This one's a when we went from the income statement, we were able to drag all of this, right?
Yeah.
That built 2021. But not everything on the balance sheet varies with sales. Okay, so the formula for accounts payable, right? If you were to drag that, right, you get nothing. And why is that? Well, it's because now you're referencing stuff that doesn't exist.
Okay, that makes sense.
Okay,
So then to find the 2021 estimated, you said we have to use like the growth rate. So
Yeah.
am I just doing what I got for 2020 and then what?
right. Then just 1 plus the growth rate.
Okay, times 1 plus the growth rate.
Yeah. Because we're looking for the total number, not the incremental difference, but the total number.
Okay, amazing. I got it. Thank you so much.
Okay. So that's why, like, when you're doing your very first, like, what varies with sales on the balance sheet, just start with cash. Okay, and get that formula correct. So you're just referencing the year prior, right? And you know you need to grow it by 1 plus the growth rate, right? And we know that that growth rate is going to be applied to a number of other variables on the balance sheet. So we want that growth rate to be consistent across the formula. So now anywhere we paste this formula that we just built, it's going to reference the cell before, and it's going to add 1 plus the growth rate to that number. So when we do that, and we do it one time, just do it with cash, just do it once, and we copy that formula, okay? And then we apply it to the 4 items that vary with sales. Now all we have to do is just paste formulas. All right. And it automatically references the cell prior times 1 plus your growth rate. Make sense? Okay. All right, next step. Okay, we know that there's going to be, and once you've got this done, like, I'm not going to step through how to calculate cash flow from assets, like those are formulas. Once you've got the data right, it's just a matter of inputting the formulas. I would go ahead, if I were you, and I'd set up your file. D just stands, it's like Greek for delta. I could change it to the symbol if I wanted to, but just change in net working capital, right? And we know that it's OCF minus, okay. And we know operating cash flow is equal to, right, EBITDA minus taxes. Okay. So you can go ahead and you can get these functions already set up with linking it back to your main tables. Okay. You know that the net capital spend, right, is equal to ending NFA minus beginning NFA. And we have to add back depreciation for the year, right? So you can get all of this set up such that when the new data is presented to you, everything just automatically populates for you. Okay, so the change in net working capital, right? Well, we have current assets minus current liabilities for the 2021 minus current assets minus current liabilities for 2020. Okay. So now we know that the CFFA for these numbers is 207,869. Okay. And it's all linked. Like these are all formulaic, right? You didn't hard code a single thing. You're using the data above it. So once you have taken the data and you've built your income statement and balance sheet, you only have to do it one time. Does that make sense? Okay. Questions? Okay, for the next few minutes, let's talk about how we take 2021 and come up with some projections. Okay, so in the case that you're given, that you're working on, right? We're talking about a marketing campaign that Tasha is considering evaluating, and it's going to last 10 years. So we're trying to figure out what incremental value that this project is going to add to her business. Okay. And we're told within the case that the revenue growth that's associated with this project, all right, is 6.5%. So now we have to flip our minds from thinking about the company as a whole. And now we have to start thinking about what does this particular project deliver? Okay. And so we're told in the case that it's going to deliver an incremental 6.5% growth. Okay. So we talked about this in class on Wednesday, but now let's, again, in Excel, let's look at it within Excel. So now we're talking about project only. Okay. And we're starting in 2022, right? Because we're done with 2021 and it came out exactly as we had forecast. So in terms of what additional sales the project is going to deliver, right? It said an incremental 6.5%. Okay. Hold on a second. I'm going to copy this over because that way I can show you how to link everything back. Ah, crap. Okay. So you're given all this information, right? So you're going to be able to link back to the revenue growth. So when we have sales, and we know that you're going to be given some number for revenue growth, some number for sales growth, right? And it's incremental. So we take their sales from the year prior, and now instead of wanting to know the total sales for the company, we just want to know how much additional sales is this project going to deliver. So we take the year prior of sales and we multiply that by the revenue growth rate. Okay. And that tells us that the project will deliver an incremental $89,375 to her toy business. Does that make sense? See the difference between the two? Here we were projecting the full value of her firm. But here we're projecting what's the value of the project to the firm. Okay, does that understand the difference between the two? If you don't, speak up. We're going to go through this many times over the course of the next week. Between now and the midterm, this is all we're going to be doing. We're going to be going through this every single lecture for the next for the next week.
Wait, so how did you get that number?
So we're looking at incremental value added to the firm, right? And you already did this, like you already calculated what 2021 was, right? And then the case told you, starting in 2022, this project is going to deliver an additional 6.5% revenue growth. Okay, so what's the value of the project to the firm? Well, the value of the project is 6.5% of what you did the year prior. Right? If I asked you for what's the total value, what's the total sales that Tasha is going to do in 2022? Well, that's the sum of both of those. Right? What she did prior plus the incremental. That's the value of the firm. That's the incremental value of the project. And that's what we care about. Okay, so if you're going to make a mistake, the mistake you're going to make is trying to calculate the value of the project the same way you calculated the value of the firm. So it's no longer 1 plus the growth rate. It's just the growth rate. You're adding an extra 6.5% value to the firm. Okay. Same thing, just like we did. Okay, we want to fix this revenue growth. Okay, so we know we're going to have to use the dollar signs. So what else varies with sales growth? Well, we know that COGS does, right? But this time we're told that SG&A only goes up by 4.5%, doesn't necessarily go up by the full revenue growth. So now we're doing it incrementally. So our SG&A is what it was the year prior times our additional SG&A. Okay. And we can also take these incremental calculations, right? Right, we can take all of these incremental calculations and we can copy those and we can paste them. Yep, that didn't work. This is gonna suck. No borders. Okay. We know gross margin is calculated the same. We know EBITDA is calculated the same. We know EBIT's calculated the same. We know EBT is calculated the same. We know taxes are calculated the same. And we know that net income is calculated the same. So the question now is, did I make a mistake? Yes, I did. I didn't fix my tax cell. So now it's EBT. Well, actually I did. So EBT times your tax rate. Okay, so click and drag. Now, I want to stop there for a second and just see if you guys have any further questions. Because on Monday, we're going to get into how we calculate depreciation and interest. Was this helpful?
Yes.
Okay, awesome. I see some thumbs up. I like that. Okay. So
the money sign keeps it constant when you apply the money sign into your line
yep,
of equation. That
Yep.
just keeps it constant.
Yep.
All right, perfect. Thank you so much.
So like with this one, right, with the taxes, we said that just tell me just whatever number is sitting above this formula, right? So in this case, it is EBT, right? Whatever number is sitting above it, always multiply that number times my tax rate. And then I could take that, right? I could take the tax rate and I could just, I could just go all the way out here. Okay.
Yeah.
And it would always take what's above it times the tax rate.
Thank you.
Okay. Because once we get through, and we're going to wrap up here right now. Once we get through all of this, right? The end game here is to be able to take all of this, once we do it one time, and then drag it on out. So we do it once, and then we've just essentially done it for 10 years. And we'll talk about that on Monday, and we'll be in class on Monday. Okay. But I kind of felt like it was important to just kind of get on Excel and talk a little bit more about how we go about utilizing the power of Excel to simplify your life, such that once I give you this table and you've already got all of this built, everything just kind of populates with all new numbers. And it was easier to kind of do this virtually than trying to figure out how to record it in the classroom when the cameras are all reversed and backwards. All right, any questions?
Yes,
Reach out.
I have a question on,
If you need to hop off, feel free to hop off. I know we just went past 10:50, so if you need to rock to your next class, please feel free. Otherwise, you're welcome to stay on as we go through some questions.
I was saying that it says I think the syllabus or something, I don't know, it says that we have a quiz on Monday. Do we still have a quiz due on Monday?
I thought I had moved it to Wednesday.
All right, so it's now due Wednesday.
You and your quizzes. I'm going to give you a quiz every single class.
I just no, I actually don't want quizzes. I just want to make sure because I don't want to be.
I thought I had moved it to Wednesday next week. I'll confirm that back with an email this afternoon.
All right, because it's not about.
You're not going to have a quiz on Monday. I can
just wanna
promise
get
you
them
that.
done.
Yeah, you're not going to have a quiz on Monday. I promise you that.
All right, thank you, Professor.
Okay.
Bye.
All right, y'all. Stay on if you've got additional questions, okay? Otherwise, have a great day. Have a solid weekend. All right, look forward to seeing everybody on Monday.
Thank you.
Cheers.